Hi everyone, this is Pranav from Smallcase. In this session being hosted by Angel Broking, we have Sonam from Wright Research who will be sharing her organization's investment philosophy with all of us. Wright Research has been one of the prominent small case managers on the platform. Wright Research is a wealth creator in the digital space that uses scientific data-driven methods to tactically extract opportunities across assets in the public markets to grow clients' wealth. Wright functions as SEBI-registered robo-advisor and is among the most popular advisors among millennial investors with more than 30,000 clients and 125 plus crores in assets. In the expanding fintech market in India, Wright Research fills the space of an expert wealth manager available in the digital marketplace. Wright Research has been democratizing access to expert quantitative investing methods for everyone. So without further ado, I would like to present Sonam Srivastava to all of us over here. And Sonam, over to you.
Thank you, Pranav. Thank you for the kind introduction. So I'm very excited to be there on the Angel Broking platform and present what we do at Wright Research to the Angel subscribers. We actually have close to 6 of our small cases already live on the platform, and we see, few users already adapting towards that. So like Pranav said, Wright Research is using science to create wealth for you guys. We use data-driven methods, we use quantitative methods to create our portfolios. To give you a little bit of a more background about Wright Research is, a favorite systematic investment advisor of the people. We have captured the millennial investors' imaginations through our quantitative philosophy. We use data-driven and AI and, all sorts of quantitative methods to create our portfolios. But our idea is that we want it to be very intuitively understandable and very transparent so that the users understand what the worth is and they adapt towards it. So it is very exciting for us that in the last 3 years, we have seen so many people adapt to our philosophy and sort of swear by it. We've also delivered very good performance in all of our portfolios. Our flagship portfolio has outperformed the index by 90% in the last almost 3 years. And our other popular portfolio Momentum has given close to 100% return the last year. We are among the top advisors on small case, like Pranav said, and we are organically growing through the word of mouth, through the performance that we are growing. And our focus is to build better and better products and to, enhance people's wealth creation journey with the, portfolios that we are offering, and always be on top of the market in providing the best opportunities to our clients. So I'll talk a little bit about myself before I, go on. I am, I'm Sonam Srivastava. I have, I started Wright Research with close to 10 years of experience in this field. I have worked in organizations like Edelweiss, HSBC, and QPlum, where I have handled large-scale quantitative portfolios and algorithmic trading strategies. I have spent, some part of my career creating high frequency and medium frequency algorithms, and then I've switched over to factor-based strategies, smart beta strategies, and the type of strategies that we offer on small case. When I used to work in these large organizations, I thought that there was so much opportunity of offering these strategies to the Indian market, and nobody was doing it. And I saw there was so much interest among the people. And after I started, I saw that there is actually so much interest and so much need for such research-driven strategies in the India market. So that is why we started Wright Research, and that is why we do what we do. We love offering these quantitative portfolios, and we see that a lot of people right now want to see such strategies in the Indian market. So that's about us. That is what we do, and that is what our philosophy and our vision is. We want to be present, and we want to offer excellent products to our subscribers and deliver it in an accessible and transparent fashion. And because we use technology and data, we are affordable for our customers. We're not very expensive because everything that we do happens through technology, and we can cover a number of factors and rationales in the market because we use data and technology. So that is what our vision is. That is what we want to do. And now I will sort of take you through some of the portfolios that we are offering on Smallcase. So see, the first Smallcase that the portfolio that we started with on Smallcase is our multi-factor tactical portfolio, right? So what the multi-factor tactical portfolio is that we look at a number of factors in the market and we tactically allocate to them, right? So what are the factors in the market, right? So a way of looking at it would be, trend following or momentum is a factor, or value, or investing into low undervalued stocks is a factor, quality is a factor, growth is a factor, right? There are a number of factors that are present in the market, and one can tactically allocate to each of these factors uh, to make the best out of the market, right? So that is what our multi-factor tactical portfolio tries to do. We try to look at a number of factors in the market and tactically allocate it to them to create stable performance for our investors. So these are the first portfolios that we started with, and we offer it for 3 different types of users. So there is one type of strategy which is a balanced strategy where you take medium risk and still you deliver, and with that medium risk you try to deliver the best performance. There is growth strategy where you take a very high, not a very high risk but high risk, where you with that high risk you again try to deliver the maximum performance for that level of risk. And then you have a conservative portfolio where you take low risk and you try to allocate to the factors that fit into that risk profile. So all these 3 portfolios have the same philosophy behind them. And to talk about what exactly that philosophy is, let's look at that here, right? So what we believe is that, markets are not described by one thing, right? Markets, they represent thousands and thousands of stocks. There are so many things, so many events, so many news, so many, themes going on that not one thing can describe the market. But based on our research and our methods, we have seen that there are broad set of factors that define the market, right? So one being the momentum in the market, one being the quality of the company, one being the growth of the company, one being the value that the company has, other things like dividend, volatility, etc. These factors can define the stock's performance in a much in-depth way, right? So that is what our philosophy is, that we think that these 8-10 factors can help us explain much of the stock market's return. And if we tactically allocate to each of these strategies, we can generate incremental alpha, right? So that is the philosophy behind this particular portfolio, that, instead of being biased toward one factor and biased toward one thing, we try to look at all the big factors and identify what would work in the market that we are in. Now, again, we talked about that there are a number of things that influence market returns, but how do you define the market, right? So the market obviously is also ever changing, right? So there are times when the market is in a bull run, it is trending and it keeps going up and up. But there are other times when the markets become volatile, right? So our philosophy is that we try to identify that the regime that the market is it in a trending regime or is it in a volatile regime? When the market is in a trending regime, then we see that, a factor like momentum or growth would do really, really well, because those stocks tend to gain strong uptrends, right? But in the times when the market becomes volatile, in those times we think that those factors are not doing well, but other factors, be it value, be it low volatility, be it even gold or bond ETFs that we include in our portfolios, they start to do well and we allocate to them. So that is our philosophy, that we try to forecast what the regime in the market is, and based on that regime, we allocate to these factors. The regime in the market is, again, we have to forecast it, right? I can't say ki, okay, historically the market has been like this, so let's allocate to this. You always have to look at the future, and when you are looking at the future, you have to forecast something, right? So we use AI driven market forecast to forecast what type of regime that the market would be, and we allocate to the appropriate factor for the given regime. So that is what we follow. And And we think that each of the factors, have a potential of outperforming in various scenarios. That's why a mix of them works really well in creating our multi-factor portfolio. So this is the performance of all the three versions of the portfolio that we offer. We have our conservative, that the performance might be low in the conservative portfolio, but the risk is again very, very low. The balanced portfolio will give you a balanced risk and return exposure, right? And the growth portfolio will give you a higher return, but a slightly higher risk. Each of our portfolios, tend to have a much controlled risk in the market because, we are very well diversified. We always look at risk along with return, right? So we just don't focus on return. We always focus on risk as well, right? So in the times like when the crash happened in 2020, the markets, the balanced portfolio gave something like a 15 to 18% drawdown when the market went down. 40%, the conservative even gave less than 10% drawdown, which was exceptional, right? So we think that this philosophy really helps us in delivering low risk and giving the best return that we can in the given market scenario. And obviously, we talked about a broad set of factors, but we believe that the factors do not stay static, right? There are various opportunities here and there that come into the market that you need to look at it incrementally account for. So our research team is always looking at new opportunities and trying to include them inside a multi-factor portfolio, right? So the strategy, how it works, like I said, is that, we identify these factors, right? We model each of these factors, and then we try to allocate to the optimal factor for a given market scenario. So we look at the targets in terms of risk. We look at, what is the, how do we maximize the return for this particular portfolio? And we have, again, an algorithmic engine that allocates to each of these factors finally. And the final portfolio is a combination of these multiple factors where you will have a bunch of stocks, right? So all of this process happens through a algo or a data-driven method, right? So there is no manual intervention in whatever Wright Research does. My job and my team's job is that we try to build the best system, build the best research that can perform these operations. So with this philosophy, we see that, our portfolios would have given, with the historical testing over more than 10 years, the expected performance of these portfolios 25% year on year. The worst drawdown that they could have hit is 18%, even during the 2020 crash, and the expected Sharpe ratio is around 2. This is the page that we have on Smallcase. I've taken the snapshots from there. You'll see that in the last 3 years, right, when this particular portfolio has been live in the market, we have given you 145% return when the Nifty has given a 60% return. So there is a huge outperformance by this particular model. You can see that 3-year CAGR is actually 41%, and this is live, right? This is not backtested. This is live in the market. You get 41% return, which is very, very exceptional for an equity portfolio. And not just that, this portfolio has been very robust in terms of the risk also, right? So if you look at this particular portfolio, you'll see that if we go to the Smallcase page and we check out this particular portfolio, you will see that it not just does it stay very robust in times of when the market is strong. It gives a very good performance, but even during times where there is a risk, this particular portfolio minimizes that risk and gives you a much better performance than the market in times of risk. So that is what is the benefit of this particular strategy. It is not biased towards any one thing. It is looking at a number of factors in the market, and like we all know, markets are governed not just by one thing but actually by a number of factors, and an appropriate mix of those factors can give you the best performance in the market as per our philosophy. So this is the core portfolio, like I said. So anybody looking to invest into the market, and you don't want to worry yourself with where should I invest, what is the factor that I should be investing in, what is the theme that I should be investing in, when should I enter and when should I exit that particular theme. If you want a core portfolio which is driven by research that allocates the appropriate factors at the appropriate time, then the balanced multi-factor is a good choice for you. And if you are a high risk investor, you can go with the growth multi-factor. If you're a low risk investor, then you can go with the conservative multi-factor. But the multi-factor investment portfolio is a good core portfolio to have, which will give you an outperformance over the market in the long run, and it will give you a tactical exposure to the various themes that are working in the market. And we have a well-defined research driven methodology that I showed you backing this particular portfolio. So this is about our multi-factor portfolio. These are the ones that we started with, and these are the ones that we have been running for the last almost 3 years on the Smallcase platform. The pricing for them is presented here, and these are very affordable portfolios that give you good performance in the long term. Now, the second portfolio that a lot of people like that we offer is our momentum portfolio, right? Momentum is a trend following portfolio, and the right momentum portfolio is one of the portfolios on Smallcase platform that has done really, really well with the momentum theme over the last couple of years. So if you know about the last couple of years, it was the time when momentum worked well, right? Stocks were going up in a very rapid pace, and that's when it made sense to be in a momentum portfolio. Now, before we go and talk about the performance and everything that this particular portfolio has given, let's talk about what actually is momentum and why should you be investing into a momentum portfolio, right? So momentum is nothing but the strong predictive power of past returns to influence future returns, right? So momentum is also known as trend following, where in its simplest way, you just look at past returns and you try to say that whichever stock is doing well in the past will continue to do well in the future, right? So that particular stock has a momentum, it has a speed which it is going, and it will keep on following that speed, right? But if you think about it from a fundamental perspective, it doesn't make a lot of sense, right? Like you think that, okay, stocks typically do well because they gave a very good earning. They typically do well when there is some appropriate news that has come into that particular stock. There is a fundamental change in the company, right? That should lead to the stock price performance, right? So why should we be betting on the speed of price change, right? So it is a counterintuitive thing to think about. And momentum is actually not driven by fundamental but by behavior in investing, right? It is dependent on the investor behavior. So if you try to understand investor behavior, there are thousands and thousands of investors in the market, and not all of them are rational, right? Even you and me, we don't always end up being the most rational people when taking decisions in the market. We are driven by our biases, we are driven by a lot of different things, right? So that's why the market also at the end of the day is not very rational. It is driven by a lot of number of biases and investor behavior characteristics, right? So typically, so if you look at this chart here, let's suppose there is a value change, a catalyst for value change in the particular stock, right? Let's suppose an earning has come, or there is a management change, or there is some contract has been won by this particular stock, or there is some change in the industry, there is some incentive. For whatever reason, there is a value change, and the stock value, intrinsic value, should go up, right? There's a signal for that, right? But not all investors immediately adapt to it, right? There are some people who might buy it, but a number of people just wait it out. They don't trust it. They see that how does it play out. They don't recognize it, right? So there is an underreaction initially, right? So the trend doesn't immediately start whenever the news comes. People take their time to adapt to, and make the buy and build that trend, right? So only after a set number of people sort of join that trend, there is a threshold number of people who recognize that, okay, I should be buying this stock. That is when the trend starts building. And once the trend starts building, a lot of people tend to herd to that stock. You hear in the market, oh, everybody is buying this stock, and many people just start herding to that stock, and then the trend sort of increases very rapidly and reaches, the value that it needed to reach. What might also happen is there could be an overreaction when, the trend has actually overreacted. It has gone beyond the intrinsic value, and then the trend would sort of start to reverse, and people would exit that. Okay, it has become overpriced, things like that. So the price dynamic is actually not very rational. It is driven by irrational investor behaviors, like I said, like anchoring, underreaction, or herding and overreaction, and a number of things like that. So the momentum strategy recognizes this irrational behavior that investors have and tries to capture such trends, right? So instead of assuming that the valuation has changed and the value will come, we actually see a trend forming, and that's when we participate in that particular trend. So that is what the momentum strategy does. Again, we do this particular strategy also in a purely data driven way. We have our quantitative methods of identifying trend, right? So we have a number of methods, be it looking at past returns over the 12 months, 6 months, etc., or a number of other technical signals through which you can rank momentum in the market. And then with after identifying the momentum in the market, we try to allocate to the stocks that have the strongest momentum, right? That is what we do. But not just that, at Wright Research, we also try to look at the risk of these stocks. So while we are trying to maximize the returns, we also try to minimize the risk, make it well diversified, make sure that there is no excess risk in a particular industry or sector. And then we try to look at the cost also. We don't change everything very often. So this particular strategy is expected to give you a 35% return over the last 7-8 years if you backtested it, and it has actually given very good performance in the live market, like I'll show you. The worst drawdown for this strategy is around 30%, right? Because it is a pure equity strategy. It doesn't have any of the bond and the gold ETFs that the multi-factor had. So this has exposure to a lot of equity factors. But here also, if the risk increases a lot, we will deallocate and take some money out of the equity market to a liquid ETF just to contain our drawdown. So this is a perfect strategy if you are a high risk investor, right? If you can't take risk with your capital, then you will see that this is the strategy that will give you high return for the high level of risk that you're willing to take. So looking at this particular strategy's performance over the last 1.5 years, almost, that this has been live on Smallcase, you will see that it has given a CAGR of 82% in that 1.5 years. And in the last, in the first 1 year of its when it was live, it had given 100% return. If you compare the same with a large cap portfolio, the outperformance is exceptional. Momentum has given a 122.95% return, whereas the large cap portfolio is only given a 38% return. Let's also look at momentum portfolio a little bit in depth on the Smallcase platform, right? So if even on the historical basis, including the backtested performance, this is a very, very strong portfolio that compounds at 30% plus returns over long periods of time in the India market. And which is because India is a market that has gone through a number of growth phases. Right? There have been a number of phases where we have seen excessive FII buying. Being an emerging market, we have seen a lot of growth happening in a market, and significant bull phases that have come into the market. Right? So because of those things, momentum tends to be a very strong factor in the India market, and that's why the momentum strategy tends to outperform the broader market by a long way. So looking at this particular strategy, you will see that it has given a 82% return CAGR in the last 1.5 years. In the live basis, it has outperformed the market very well. And there is always a lot of concern that momentum is trend following. Then what would happen in times of risk, right? So to identify that, just look at the last 6 months of performance. In the last 6 months, when the market has been flat, the momentum portfolio has given a 10% return in the last 3 months again, the momentum portfolio has been robust. In the last 1 month, it has outperformed the market. It has been quite robust. So not just in the times of trend, but also in the times of risk, the momentum portfolio has stayed very, very strong. Right. So that is the merit or the benefit of this particular portfolio. And that's why it is a very popular portfolio among a lot of investors, because it gives you a very good value for the money that you put into this particular portfolio, and it stays robust not just in trending times but also in risky times. The allocation of these portfolios, like when there's a trending market, like in the beginning of last year, we were betting a lot into cyclical stocks, metals, right? Things like that, because those were doing really well. But we have bet a lot on technology all through this particular portfolio. But recently, as the market has shifted, again, we have made a shift, with the Ukraine Russia crisis, we've shifted, we have had some allocation to metals and tech bias more, and that has led to a better performance in this particular portfolio. So that is about momentum, and it is a very interesting portfolio that our investors tend to like a lot. And like I said, the performance of this particular portfolio has been really robust over the last 1.5 years. The third portfolio that I would talk to you about is our newest portfolio that we have launched only less than a year ago, and this is our innovation portfolio. Our innovation portfolio tries to invest into the future, right? Our innovation portfolio, what the theme that it is based on is that whenever there is innovation in the market, right, whichever company is doing innovation in the market will tend to outperform in the long term. So that is a simple philosophy that this particular portfolio is based on, right? And it seems like a generic saying when I say that innovation will outperform the market, but there is science behind this also, that when a particular company or a sector starts doing innovative things that really enhance the lives of people, like let's say an electric vehicle company, or let's say an e-commerce company which really changes how commerce is done, or let's say a biotech company that really changes the pharma or the healthcare landscape. Things like that, they tend to start slow, because it is a research driven project. It doesn't give you very good profit initially, right? It takes time for it to be profitable, but eventually when the whole market adapts to it, and when there is the production has been perfected over the long time, these things become profitable also. These things become very attractive to the broader markets also, right? So any innovative company that is lasting for a long time, that has support, and that is enhancing people's lives with the power of innovation, tends to outperform on the long term, right? So that is what we are betting on. In the innovation portfolio, we look at 4 themes in India, right? One being electric mobility, which is your electric vehicle ecosystem. So we have electric vehicle manufacturers, we have batteries, we have power companies that are betting on EVs, right? So we have all the components of the EV ecosystem in our portfolio. Along with that, we have the e-commerce set, right? So in the e-commerce set, we are betting on disruption in terms of companies that are launching these platforms that are really enhancing the life of the consumer. And obviously, there are when we started this portfolio, which was a year ago, at that time there were very low number of companies in e-commerce sector live in the market in India, right? All the IPOs that have come into the e-commerce market, be it Zomato, Paytm, Nykaa, etc., right, have only come in over the last 1 year. So when we started, there was a small number of companies in that sector, but now that the universe is expanding, and even in that universe, we don't just include all the things, all the companies in this particular portfolio. but we again dig deep to understand, the potential of that particular company to be an innovator in the long term, right? So recently, we have added Nazara Technologies, we have actually added Angel One, we have added uh, mm, Map by India, and some innovative stocks that in this sector, which are really driving the change. We also bet on fintech and digital revolution in this particular company. So like I said, we included Angel One and we included a bunch of other companies in the fintech theme, to like 63 moves, etc. in this particular portfolio that are really, driving the innovation in their particular industries. And this portfolio has again, performed really well compared to the broader market in the last 1 year. Last 1 year, the performance is 62%, which is a tough feat, right? Because last 6 months have actually been volatile for all of the market, right? But this portfolio has been quite robust. When the markets were strong till October, this portfolio was outperforming in leaps and bounds during that time. And when the markets was volatile, obviously, innovative companies tend to be valued higher, right? There is overvaluation of these companies because they tend to, the profit generation or the revenue generation might be slow in the beginning, but the expectation is higher, right? So that's why people think that, okay, this company is being overvalued because the numbers are not showing. And that's why when the risk comes, people tend to shy away from such companies, sell and leave. But in the long term, when the market sentiment improves, these companies again pick up the trend, right? So if you look at the performance comparison over the last 1 year compared to only the Nifty, we have again 40% outperformance. In the last 1 month, 3 months and all, we have done well. Obviously, when the risk comes, innovation faces that risk in a higher way, like I said, because these companies tend to be slightly overvalued. But in the long term, it's a very interesting portfolio, and it is a very, and I really like that this portfolio is betting on innovation in the country. And we see that a number of companies will come into, as the growth in the equity market in India happens, it will happen through the innovative companies only. So this would be a very, very interesting space to bet in, and it would really drive outperformance. This theme would really drive outperformance into the future. So this is our third portfolio that I want to talk to you guys about. The fourth portfolio that we have, which is a very interesting portfolio, is the small cap portfolio. Small cap portfolio is a portfolio where we only include smaller stocks, right? So we don't include any mid caps or large caps in this particular portfolio. We only include small cap stocks. Why do you bet on small caps? See, like I said, India has gone through distinct growth phases, right? And whenever there is a growth phase in the country, whenever there is a growth phase in the economy, during those times, small caps tend to grow at a much rapid pace compared to large caps. And why is that? See, small caps grow at a rapid pace compared to large caps is because small cap stocks are smaller, right? So once people recognize the benefit of a smaller stock, you will see that because its size itself is small, the growth rate would look proportionately higher for smaller stocks, and that's why they tend to grow at a rapid pace. And especially during, like I said, growth phases, small caps tend to outperform large cap by a wide margin. So we see that, like in the last year or so, small caps have done really well compared to the market. And in the future also, as the market recovers, small caps will tend to do better and better compared to the market. This particular portfolio is also driven by quantitative methods. Here again, we look at multiple factors in the market. So it's not just like we are looking at one factor for small cap, we are looking at multiple factors in the small cap portfolio, trying to allocate to it, trying to reduce the risk, maximize the returns, look at the cost, and give you the optimal portfolio of small caps across sector industries without taking a lot of risk in one particular stock, industry, or sector. This particular portfolio has given, has expected return of 35% and the worst drawdown of 30%. This is the performance of the small cap portfolio. On the small case page, so if you look at, so this particular portfolio has given again a 40% CAGR in the last 2 years, which is exceptional. Obviously, it has some amount of risk because, small caps tend to have risk, when the market becomes volatile, small caps tend to underperform the market by some bits. But yeah, it becomes robust and it does come back in a good way whenever the market recovers, right? So our small cap portfolio has been robust compared to the index, and we have always tried to allocate to the best factors in the small cap portfolio to give our users the best performance, right? The costing of it is very affordable, and obviously it is a high risk portfolio. It is not a low risk portfolio. So we recommend only the people, who are willing to take high risk with this, who want to bet on the small cap growth story, should be investing in this particular portfolio. So I think those are the 4 portfolios that I wanted to cover in this particular session. And I think, this was informative, and, this would, sort of help you guys in understanding what the Wright Research does. If anybody wants to reach out to us, you can find our contact details and all our social media profiles on our website. And we'll be very happy to guide you through, our portfolios. So Pranav,
Sure. So thanks a lot, Sonam. This has been quite informative. So before we actually conclude this session, I've prepared a list of 4 questions that our users generally tend to ask us when we speak about small cases which have been designed by Wright Research and so on.
Right.
So I would like to pose these queries to you and try to take your inputs on it. So the first question being, how has your experience with your current investors been so far?
Yeah, so I really enjoy, interacting with our current set of investors, and our investors, come to us because they trust the philosophy behind our products, right? Like I said, that all of our products, while they're driven by technology and data, have a very well-defined method behind it. That when well-defined thing that we are betting on, people sort of trust that and trust that Wright Research will do the best in giving them the best performance. So I mean, we really enjoy the trust that our customers give us, and we really want to do the best and bring out the best for their portfolio. So it has been an excellent journey. I mean, it has been a totally amazing, rewarding journey for us in the last few years that we've been a small case. It's amazing relationship that we have had with our customers. Yeah.
Got it. Okay. And I know that you've covered my next question already for one particular portfolio, but I wanted to make it a little generic and ask you if you have a philosophy built into it. So how are the small cases, how are all your small cases expected to perform during turbulent market conditions?
Yeah. So see, we are always, Wright Research is always, we talk not just about returns, but we are always focusing a lot on risk also, right? So in all our portfolios, we have a risk management philosophy built into it, right? So like our multi-factor portfolio has a mix of equity, gold, bond, right? So whenever there is volatility in the market, it deallocates, goes into bonds and golds, so to give you a good performance in risky times also. Our momentum portfolio also has a deallocation policy. Our innovation and our small caps also have a deallocation policy, that anytime there's a short-term drawdown, right? Like in a very short span of time, the market goes down by 10%. Now, obviously, there is a risk, right? There is some event that has happened. During those times, what we do is we deallocate the capital, take out 10% of the capital, put it into cash, right? And if the crisis continues, then we keep on deallocating so that we don't face too much of a drawdown. We can save some money for the clients, and as the market recovers, we again reallocate and we move on, right?
Right.
So we always have that thing built in, which reduces the drawdown for our portfolios.
Got it. Understood. So in that case, would you be changing your investment philosophy in the long run if the broader market conditions start changing?
So we see our investment philosophy for the like I said, for the momentum portfolio or for our innovation portfolio is very well defined, right? There's no scope for change. Obviously, what we will try to do is, do momentum better. Maybe look at other signals that who can give you better momentum. So we always try to improve, right? Which is something that we always do. But in our multi-factor portfolios, we are already using a large set of factors that we are looking at, right? So if we think that, suddenly in the factor, there is another interesting factor that we should be looking at that we haven't been looking at, then we will go and explore that. So like, yeah, so which we have, also done many times in the past that, we have included more factors into the mix and try to make it more robust. Yeah.
Got it. Okay. And my last question for you would be, do you plan on launching any new small cases in the future?
See, I think that our product set is very comprehensive right now, and I really like that the themes and the factors that we cover. Especially for the Angel One customers, I think we don't have the innovation portfolio live on the Angel One side right now. So what we would try to do is to first make the innovation thing active on the Angel One portfolio, and obviously we are always in the lookout of finding more interesting things that we can bet on. So in the future, we'll look at doing more interesting portfolios.
Sure. All right. So that's all the set of questions that I've prepared for you. And on a closing note, thanks a lot, Sonam, for coming over to this session and sharing your philosophy with us. And at the same point of time, I would like to thank Angel One for hosting this particular session. So for all of you who have any other further queries, you can feel free to reach out to the support team at Angel One, and they will be able to respond to you promptly. So thanks a lot, everyone, for tuning in. Thanks, Sonam. Yeah.